Welcome to Mortgage Markets and More. I'm your host, Peter D'Angelo. I hope you're doing well and had an awesome weekend. Back to a full week this week, and we've got a full market rate update for you. It's been very volatile. Let's start off by saying that. So instead of just diving into what the rates are currently looking like, let's take a look at what's setting the stage for the current rates and where they're going, at least in the short term for right now. We've talked ad nauseum at this point, yet again, about how there was expectations for a rate cut in March. That hope has now been dashed with some hotter inflation data, which we're going to get into in a minute. But there is still a lot of optimism by investors that we're still going to see rate cuts this year earlier rather than later. At the very beginning, I can tell you it's the dissonance between the expectation and reality that's creating the volatility that we're seeing. Things are not aligned between the people who are trading in the market and what their expectations are and hoping that the Fed cuts the rate to stimulate the economy. Newsflash, the economy's doing great. The economy is breaking records. And last week we saw NVIDIA had their earnings call in the middle of last week. Think about this. NVIDIA is all about chip making, and particularly every time you hear anything about AI, it's feeding NVIDIA's business. So they're selling their chips. The unit cost is like $30,000 per chip, and I think between Meta and Google, they're selling them to each of them to the tune of around 150,000 chips last quarter to each of them. So they went gangbusters on their earnings call, which is helping to support the stock market. The stock market right now is being moved a lot by what's called the Magnificent Seven. There's 7 stocks that are really creating the upward trend in the market. And I don't want to go too in-depth into that because we're here to talk about mortgage rates. However, these things do play a role in where mortgage rates are going and how trading happens in the market, which directly affects mortgage rates. Again, it's not just the Fed and what the rate is for the Fed that creates the mortgage rate environment. The Fed is a big component. Anticipation of what the Fed is going to do is a component, as well as how the market is trading. That's a direct correlation to where mortgage rates are going. So we're going to start off right now to go back and look at the Consumer Price Index, CPI, and the personal consumption expenditure, which we talked about 2 weeks ago now, or a week and a half ago on the Friday update. The CPI data I'm about to share is from Macro Micro, which is fed by the U.S. Labor and Statistics Bureau. So we're going to focus in on the shelter cost. We've talked about this in the past. The Consumer Price Index is to show the price changes year over year, and it takes into account everything that consumers spend money on. Within that is a tranche of data about housing and shelter, and it gets weighted differently, and that's why you'll hear different numbers when people talk about inflation. Are they talking about CPI, the Consumer Price Index? Are they talking about the personal consumption expenditure, the Fed's preferred inflation gauge? That's not information that typically gets shared when you hear the numbers of where inflation's at, but we're going to break that down. In March of 2023, looking back, we peaked at CPI for shelter at 8.16 year-over-year growth. And the personal consumption expenditure, the PCE, the Fed's preferred inflation, excluding utilities, we're just talking about housing cost, April of 2023 is when we saw 8.2% year-over-year growth. So that was the peak, and that is still within 12 months of us right now. So we're not that far away from when we peaked. However, we are trending downward rather healthily, but definitely not in a straight line. There's bumps in the road on the way down, and it's those bumps in the road that are creating the volatility that we're seeing right now for mortgage interest rates. CPI shelter in January was 6.07 year-over-year growth, which is down 2.09%. For context, the headline inflation for CPI was at 3.1%. That's what it was in January. We're talking about the shelter component, which means, okay, if shelter's at 6.07 year-over-year growth, other components that are within CPI are lower. So that's what's giving us the CPI reading that's overall lower than just shelter. However, shelter continues to be high, but it's down 2.09% from the peak we just talked about. The personal consumption expenditure for January will be available on February 29th. So I may pepper that in with the real estate update just to give you guys some context there too. But it's sat at 6.37% year over year growth, excluding utilities for December. The takeaway here is that the trend is downward, so we're making progress, but there's an over optimism in the market about expectations and that analysts have, and that is the source of the volatility that we continue to see. When I'm talking about volatility, I'm talking about how you could have been pre-approved in January and been quoted an interest rate approximating 6.4 or 6.3, and now the same borrower, the same qualification, the same property type, down payment amount, all of the things that would affect the interest rate, all that's the same, and now that rate's closer to 7%. And that just happened in a month. And people back in October who were shopping for a home know the pain and felt the pain, because that's when we saw our interest rates peak. We saw the interest rates peak 8% plus in some scenarios. So it's not a steady line downward. Expectations are for a steady line. That's not going to happen. And as long as the expectations are still overzealous, we're going to see this volatility happen, and mortgage rates are not going to be consistent. We're going to see this happen up and down, up and down. How much the margin is will depend on the data and the information. But as you can see, as we're looking at here together, it's not 100% yet. We're not at the Fed's target. And until we're really close to that target, we're not going to be seeing any relief on the mortgage rate side from the Fed through their rate cutting. June of 2022, right? Let's talk about this. That's when we had the peak for the CPI. The consumer price index was at 9.03% in June of 22. The downward trend is present. However, we bottomed out recently in June of 2023 at 3.05%. So if we see CPI, consumer price index, and inflation indicators break through the floor of the 3% range, and we start seeing the headline CPI getting down underneath 3%, and this way, when there's volatility, if the CPI does pop up a little bit, if we have some headroom there and we can stay within 3%, now we're in the game. We're starting to get real close to what the Fed's inflation target is. And I would only imagine that those circumstances would create an environment of more consistency and less volatility. Like I've said before, it's the volatility that's the killer right now when it comes to mortgage interest rates. Now let's actually talk about the mortgage interest rates and what's going on here. The rising rates are significantly reducing home buyer demand as well as buying power, and one kind of begets the other. So if you were shopping in January, you had a price point you were shopping in, now rates go up 0.5%, and you were maxing out your qualification, what you could qualify for as working with your mortgage professional. That's now changed how much buying power, how aggressive you can be. And as we talked about on past episodes, there was quite a time in January and even leading into February where it was an expectation that you were bidding over ask. No one was bidding at asking price or under. It just wasn't going to get your bid to win when you're placing your offers on properties. So when you're shopping for a home and you're looking at a certain price point and now the interest rate goes up, your buying power decreases. Now you've got to look a little bit lower because the demand could still be high. There's still quite a bit of cash sales happening. So competing with cash is definitely an obstacle. And there's pent-up demand beyond just the cash offers, but other individuals looking to obtain financing to purchase a home, that's pent up. So there's a lot of competition in the market right now. And what we saw was a rather consistent and significant drop over the past 4 weeks of mortgage applications. We could take this a couple ways. One good news way, let's be Pollyanna for a minute. The good news way is there's less people applying and there's less people trying to get in the game to get qualified and to look to purchase. That means competition could be softening. We'll see. On the other side, though, it could mean there's a lot of people who are disenfranchised yet again, and now they're pulling the chips off the table and they're going to wait until rates come down again. But as we've talked about before, that's not necessarily a pathway to success because the price points could be much higher, which we're going to get into on Friday. We're going to talk about price points, where they were in January, and what we're seeing through recent surveys and outlooks for home values. Last week, in particular, we saw a seasonally adjusted 10% drop in mortgage applications for purchase loans, that is. And that's a 13% decrease from the previous year. Super softening of demand when it comes to mortgage applications, which is our first indicator of who's going to be shopping, right? If you're going to be getting financing, you should be submitting your mortgage application in first, getting pre-approved so that you know what you can afford and what you can shop for. If we're seeing a big drop, that means over the next 30 to 60 days, there's going to possibly be less competition in the market. The only reason why this isn't 100% we can say with confidence is because of the fact that there's so much pent-up demand, and new applications don't mean less people on the street. There are people that have been shopping for years at this point, and they don't get captured by those new application data that we got from the Mortgage Bankers Association. Refinancing's also taken a hit, but that's been kind of the status quo because rates are higher. So who would refinance if they're currently carrying a mortgage rate of, let's say, 3 or 4%? No one's going to refinance that debt. Even if you want to consolidate credit card debt or pay off student loans to consolidate things, you're not going to be doing that by refinancing your first mortgage. There are other products available. Like here at Guaranteed Rate, we offer a home equity line of credit, and it's a great way for individuals to consolidate their debt. That's a second mortgage product. That doesn't affect the first mortgage. That doesn't get captured as a purchase application because it's a refinance technically. And two, it's not going to be captured by refinance data because it's a second lien. You're not necessarily refinancing the debt that you have on the property. The influence on the mortgage rates, as we've talked about, certainly affects buying power, and then that also affects how many people are going to be shopping. So with mortgage rates moving back above 7%, we're going to get into that in a little bit, due to the inflation concerns, see the CPI and the personal consumption expenditure that we looked at just before. Those are setting the stage to show that inflation's not coming down like a stone, and there's bumps in the road. Those bumps cause mortgage rates to go up a little bit. Let's just get right into the mortgage rates at this point. The 30-year fixed rate conforming mortgage, they averaged at 7.06, which was up from 6.87 for the week of February 16th. For reference, last week, wrapping up the week, they were at 7.14. That's the average. This is according to the Mortgage Bankers Association. The 30-year fixed rate jumbo mortgage, those rates averaged 7.16 the week of February 16th, up from 7% the week prior, as well as an increase to 7.39% last week. The 30-year fixed rate FHA mortgage, those rates averaged 6.91% the week of February 16th, and then came down to 6.68. Now we are at 6.63. 15-year mortgage rate was averaging 6.61, and that was up from 6.53, and today we're up to 6.55. And the 5/1 adjustable, these are adjustable rate mortgages. You get one rate for the first 5 years, 5, and then /1 every year. Annually, your rate adjusts. Sometimes you get a little bit of a benefit with an adjustable rate mortgage because you're not locking in your financing for long term. You will have exposure after the first 5 years. That gives you a little bit of a discount because you're going to have your rate updated when the market changes. So think about it from the lending standpoint. They don't need to necessarily calculate out how much is money going to be worth 5, 10, 15, 20 years from now like we do with a 30-year mortgage. That's why it's tied to the 10-year bond so closely, because the 10-year bond is a good indication of where money will be in 10 years. What's the value? For the 5/1 adjustables, they were at 6.37, and then last week went up to 6.82. The market in the beginning of the year was very good, mainly because we had a lot of great information, positive information about cooling inflation, that inflation was coming down when we wrapped up 2023. Now, as we're going into 2024, we're seeing some hotter inflation data, hotter than what the expectations are. Again, I'm highlighting that. Expectations are what's driving the volatility. It's not the fact that, oh, just because it didn't go down again or it popped up a little bit from the last month does not necessarily mean, oh, the world's on fire, inflation's going to start coming back. It's just that expectations were that they wanted to see inflation continue to cool, and that isn't happening in a straight line. So those dynamics are creating a higher rate environment, a more costly environment, which will take people out of the game or have to look at their strategy with their real estate professional to see what's going to be most appropriate to give them the best opportunity to place an offer that they're going to have accepted. January was good. When we talk on Friday about the sales data, that's going to be really reflective of the mortgage rate environment of December and November, because anyone who got into contract were getting into contract in December when they closed in January, and a small percentage may have gotten into contract in January and closed the same month. But by and large, industry standard, 30 to 45 days for closing. So back in December is when those contracts were entered. That rate environment was extremely favorable when we consider where we're at right now. There's almost a whole percentage difference there. However, there's also almost a whole percentage difference from the peak mortgage rates that we saw in October. We're very much middle of the road right now. We talked about the 52-week average 2 Fridays ago, and right now, based on that average that we identified over the past 12 months, we're sitting pretty squarely in the middle. We were in the bottom third when we had that conversation 2 weeks ago, but now we're kind of squarely in the middle, starting to, at least if we're not directly dead center, we're on our way there. The comparison to the peaks and the recent trends of what was happening, they peaked at around 7.83% in October of 2023. And now the recent rise is almost about 0.4% up from where we saw the low this year. So there's still a lot that's working out, and there's still a lot of volatility. This is the opportunity I'd like to take to remind everybody that if you are a would-be home buyer, prospective home buyer, regular communication with your mortgage professional is essential. I like to be proactive about that. Part of the reason why I do this podcast is so that I have a resource for my clients and for everyone that I do business with, but also I need to be reaching out on a regular basis to make sure everyone's expectations are in a line, and also to avoid the very disappointing experience of having your pre-approval set with a lower rate environment, and then rates go up, you place an offer on a property, and now you understand that, man, that's outside of your budget, or you don't qualify. I will say this. One of the great things that I'm seeing is that would-be home buyers, particularly first-time home buyers, are very prudent about what their budget is. And that's so important, making sure that you're managing everything to your budget. So sometimes if you're managing toward your budget, but you can qualify for more, you may still be in the game if you can make do with being above budget. But right now, I would never recommend that. I would always say, have the mortgage rate and the monthly payment now that you're comfortable with now for the future. Like I said, there's probably going to be an opportunity to refinance in the future, but when that is, we don't know yet. And it's important to know that you are comfortable with the monthly payment that you currently have. We can't talk about mortgage rates without also talking again about the Federal Reserve and their interest rate possibility of cutting this year. And right now, it's at a standstill. March is out the window. Now they're turning their gaze to June. There are some investment firms and analysts that are expecting still 1% over the course of this year, decrease in the Fed fund rate. That's one of the primary drivers for mortgage rates. But my personal opinion is I don't see that as likely unless we see significant deflation where, we see our inflation cool to a point where we're reaching the 2% target. And we also got last week the Federal Open Market Committee minutes, which kind of pull the veil back. We get to understand what the conversations were at the Fed meeting leading up to the Fed's announcement when they said they were holding rates and that they are going to remain data dependent and need to see further improvement on inflation toward the 2% target. Those minutes reflected they're all in a holding pattern. Rate hikes weren't really on the table. The possibility of rates going up, that wasn't really noted very much, but they didn't say that it's not possible if inflation rears its ugly head in a big way again. However, they're going to stay the course and they want to see inflation come down. There's also a component to think about here where, the Federal Reserve needs to act insulated from politics. And if they're going to do anything, the precedents in the past leading up to a presidential election was for the Federal Reserve to kind of be in a holding pattern, because the optics of them doing anything with the monetary policy leading up to the election could be construed to support an incumbent candidate possibly. So in this case, our current president. It'd be a difficult line for them to toe. If they do see data move in the right direction, it would need to be categorically that we see inflation either at 2% or within striking distance of 2% for them to lower the Fed fund rate leading up to the election. So that this way, there's no question about it being a possible political move. These are things that we need to consider as we're looking at the overall outlook for mortgage rates. So now, as we're going forward, especially for the next couple of weeks, expect for rates to continue to possibly go up. We were talking about the 10-year bond, and as we mentioned, that's a very important indicator for where mortgage rates are. About a month ago, the 10-year bond was hovering at a yield of around 4%, plus or minus a little bit. This week, we're seeing the 10-year bond almost reaching the level of 4.4%. So that increase is going to create an environment of higher mortgage rates. It's as simple as that. When we see that 10-year bond start to come down and maybe some better inflation data showing it cooling, like I said, it was a mixed bag by the numbers. It was mixed. It wasn't all bad or all good. There were some good things. There were some bad things. But everything needs to be good in order for the market to be optimistic enough for interest rates to come down, which we're just not seeing yet. If you're making and developing your plan for home ownership, rates aside, get pre-approved, understand the process, work with a professional, call me, reach out to me if you've got questions. And then from there, that's where you can develop your strategy as far as if you want to be in consideration of mortgage interest rates. Best practice, in my experience, is to let your monthly budget guide you. Let your monthly budget guide what will work best for you, what price point to shop in, and then pair up with a great real estate agent that knows your market inside and out, and then you'll have the best likelihood of success. That is it for me today. Thank you all so much for listening. I hope you enjoyed the show. Please like, share, subscribe, download our episodes on Apple or Spotify. We also have a YouTube channel, so every podcast is up there with a video. Sometimes there are graphics included, particularly for our National Association of Realtors sales data when we do that monthly. So those are really good ones to watch. We have the data slides up. And if you have any questions, feel free to reach out. I always would love to hear what you're interested in hearing about, as well as helping you along your journey of home ownership. I hope you guys have a great week ahead, and I look forward to talking to you on Friday. Take good care.